And then secondly, I will bring up a new share of our option hotline disclaimer.
Good point.
So everyone that is on with us, please pause or please take a second to read this very brief disclaimer. And beyond that, Keith, I will stop sharing and please take it away.
All right. Let's see if I can do this right. Do you see the correct screen there? Should be a simple trick to improve your trading odds.
We see it.
Perfect.
And can hear you loud and clear. So great.
Excellent. Oops. And that's my little Dropbox warning, of course. Okay. So for those of you that don't or aren't familiar with our webinars, if you have any questions, feel free to throw them into either the Q&A box or the chat box. And if I can, I will address them during the presentation. And if not, we'll try our best to get to everything we can at the end. I'll also include my contact information in case we can't answer your questions now and you come up with something later. But what we're here for today is what I just think of as a simple trick to improve your trading odds. And it's nice because the market right now is trying to give us the opportunity to take advantage of this. Before I start that, I always have my own disclosures. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Similar to Steve, I'll give a few moments here for people to read through this and make sure that you all understand the pure educational nature of what we're doing here. All right. So Steve gave a brief introduction to me, and I always appreciate that. I'll also do my own here because I always include it. But I started in the pits of the CBOE back in 2005, right before the subprime crisis hit. Traded as a market maker through the subprime crisis. Then as the markets recovered, they changed drastically for market makers. Market makers made a lot of money on wide markets and very active wide markets. As markets recovered, it became more of a nuanced game where there had to be more of a bias than just simply being a market maker. I recognized that and decided that I needed to learn a new focus on how to really gain an edge over the rest of the trading world and develop my expertise in options nuances like skew and term structure and all of that good stuff. As I went through doing that, trading options on European bonds and options on gold and silver, recognized that really the final, or at least hopefully final stage I really needed in order to have a great edge over the market was to be able to predict direction. So technical analysis, things of that nature. And the best way for me to do that was going to be to join a hedge fund. So I went to the University of Chicago for my MBA, graduating with honors with a concentration in analytic finance, entrepreneurship, and statistics and econometrics. So basically, sort of a heavy math analytics focused MBA, and used that to leverage a position with a hedge fund where I traded precious metals and basically structured all of their options trades as they told me what they believed about the direction. It was a great exchange of knowledge because I could learn more about technicals and they learn more about options. So, we basically exchanged our knowledge well, and that helped me transition to helping the retail trader because frankly, when you're working for a hedge fund and you see billionaires getting richer, it's not all that rewarding. More rewarding to me is to try to help people that are struggling with their options trades or struggling with their directional trades and find ways to leverage the market in a smarter way. So that's why I started Trade Academy, was to try to help the community of traders trade smarter. Joined Option Hotline because just believe in what we're doing here as well as the Chief Options Strategist, and really been focused on options, of course, but with a directional bias, focusing a lot of times on equities and also commodities. So we've got a nice stable of other people that are helping out with Option Hotline as well and presenting, and we have great authors. And I hope that what we talk about today will also help enrich your trading. If you do have to leave early, since I know many people have other commitments, you can always email me, keith@optionhotline.com. There's my phone number as well if you'd like to call. I'm most available via email, but I'm happy to take a phone call and talk markets with anybody at any time. Also, make sure you keep an eye out for webinars at optionhotline.com in your inbox to receive a free giveaway for today. Sometimes it ends up in your spam filter, so definitely double check that tomorrow, because you definitely want to get anything you can for free. Obviously, that's the nature of options trading, is trying to leverage both the free and the premium content that you can get. So what we're going to talk about today, I'm going to do a very brief intro on options for those of you that aren't as familiar with options. A lot of the people I talk to really still aren't that familiar with options, so I always try to give at least a brief understanding of what really, in this case, a call option does. And then we're going to get right into the simple trick for improving trading odds, specifically thinking about the way people tend to trade options when they have a directional view. Then we're going to try to apply that trading philosophy to long-term trends. Medium and long-term trends just really work well with this trading philosophy. And then I'll talk about the sectors I'm really watching right now as potential spots to really get good leverage applying this trading philosophy. The thing to have in mind is, as always, I try to talk a little bit about the programs that we run at Option Hotline. This is the Option Trend Trader returns from 2020. We usually update these on an annual basis, and what we saw was about just under 150% return for 2020 in this portfolio using this strategy. So when we use this strategy right, obviously you can see how it can still generate very nice leveraged returns relative to an equity portfolio. Options do have risks, and that always has to be known. There are increased transaction costs traditionally with options. There is an assignment risk if you are short options. We don't trade short options in this strategy or in this model portfolio for that reason. It tends to be simpler to have positive leverage, especially when the VIX is as low as it is right now. That means implied volatility is cheap, means options are cheap. We're finding better leverage overall in the long options setups. Options do decay in value over time. So that is an increased risk of being long options. And it's going to be a big focus of what we're talking about today, and how to avoid some of that decay when you've got a market set up like what we've got right now. And then volatility. The value of options is partially dictated by implied volatility. It's one of the key inputs to the model. That is the predicted future movement of the underlying asset. So we're trying to predict how much it's going to move over X period of time. So if you have an option expiring in 1 month, we're trying to predict how much this stock could move over the course of the next month. Right now, implied volatility is at least short-term historic lows for the last few years. Long-term, it can go lower, and realized volatility has been lower than that. So one of the things we have to be very cognizant of is when we're trading options, we're always trading volatility. We're always trading predicted future movement. If you don't get a leveraged opportunity because of low volatility, you can easily lose money even if you have the direction right. And that comes a lot from the decay. So these are the key ones that we're looking at in general for the strategy. And there are other risks to consider, but these are the ones that I really want to focus on, because our two here, decay and volatility, are two of the key ways that this strategy can work. So why is options? This is just a simple comparison of stock to options. If I have a $10,000 portfolio and I want to buy $10,000 worth of a $100 stock, I can buy 100 shares. In theory, I have unlimited upside, but at the same point, I have downside to the amount of money that I put in. I can say that I have a stop loss if the stock goes below $90, but there are two problems with that stop loss. Number one, there is a risk that this stock could come out with unexpected fundamental news and cause the price to drop well below my initial stop loss. So I can lose more than the $1,000. You can just have a theoretical situation where a stock comes out and says that they've been lying every time they report earnings. And this does happen, unfortunately. And that can cause you to lose a lot more than the original $10,000, than the original $1,000 of risk you thought. And that would be capped at the $10,000 investment. Additionally, there is a little bit of an emotional element of trading, as many of you are probably aware. Sometimes people fudge around with the stop loss and miss out on the exit. So one of the things with stock is that there are ways that you don't end up risking what you thought you risked at the beginning. But with options, you're risking what you risked at the beginning. Because if the stock goes down, I can only lose the premium I paid. So I can get more exposure to stock by buying call options. How does it work? Well, frankly, if the $100 calls expiring in 1 month, which gives me the right, but not the obligation, to buy the stock for $100 anytime in the next 30 days, are priced at $5, then I can buy 2 of those calls, each representing 100 shares. So I can represent 200 shares of stock, and my total investment would be $1,000. So I have the same risk to the downside. If the stock goes to $40, I only lose $1,000. If the stock goes to 120, though, I'm now controlling 200 shares instead of 100 shares. And you can start to see how it can perform better when you get the direction right. And it can perform better if you get the direction way wrong. So at $90 and between $90 and 110, the stock position's better. It just is. But above $110, I've got crazy leverage. I can make a lot more money than I could have in that stock. Below $90, I've got limited downside, so I lose less. So this is the trade-off. We trade off for the small move in order to try to achieve a big move to the upside, and also to know that I can sleep better knowing that even if something bad comes out, I'm okay. We've had a lot of stocks that have dropped 50% overnight in the last few months. It's because sometimes these stocks get overvalued, and then one negative piece of news can create a major problem. It's not happening to the whole market, of course. The whole market right now is basically just doing new highs every day, and that's great. But there are individual stocks that create lots of risk to the downside, and any of these stocks, we never know if they're going to liquidate. I mean, just look at Bitcoin, which everybody was saying was still too cheap at $60,000 a coin. Look at it now, not so much close to that level. So there's always risk in these options, and this is why I trade options more so than the equity, because I can control my risk, define my risk, and achieve leverage. So the big key for today with this strategy is built upon the fact that these options have Greeks. So instead of just having a directional risk like a stock, options have other Greek risks. These are really associated a lot with those risks that I mentioned before. The first one, and the most obvious is of the first order Greeks, is called delta. This is the change in option value relative to the change in underlying price. So what it means is if I have the delta range is between 0 and 100. A 0 delta option effectively means it's not going to work out. And no matter what happens to the stock, I'm not going to make money. But I'm also not going to lose money at that point because it's 0 delta, which means it's effectively worthless. Now, a 50 delta option is something that is directly at the money. 50 delta is directly at the money. So if the stock is $100, the $100 call will be 50 delta. If the stock goes up $1, I expect to make 50 cents. So if you think of delta as a percentage, whatever the delta is, that's the percentage of the move you get to appreciate from the move. Now, for lack of movement, we have theta, passage of time. So even though I expected in a stock to make $50 for a move up $1, because I had 50 delta, so I was controlling 100 shares, I can lose that much or more in theta if it just doesn't move enough. So we always have to be worried about theta because that's offsetting the delta. Even if I had the move directionally correct, my theta can hurt me. A stock coming into an option coming into expiration, let's say this Friday, if it's a $100 stock and it's up only 20 cents tomorrow, I'm probably losing money. Even though I thought that I should have made a little money from delta, theta is likely really hurting me. So that's our decay issue, really accelerates as we get close to expiration. So that's a big risk when you've got a market like this where implied volatility is low, but realized volatility is lower. I always address row. We don't have to worry about it too much. It's the change in an option value relative to change in interest rates. Interest rates are very close to 0%. There are very little minor changes that the FOMC keeps doing, mostly talking about what they're going to do 2 years from now. So row doesn't normally have a huge impact on these short-ish term options, things that are expiring in 3 months, 6 months. Row is just not that consequential today, given where interest rates are. If we return to the interest rates regimes of 5, 6, 7%, with major fluctuations over the course of any month, then it can change a lot. But right now, it's really not a risk that most people are overly concerned with. And then implied volatility. This is Vega. This is the change in option value relative to a change in implied volatility. So if implied volatility goes down and I'm long Vega, I'm going to lose money. If implied volatility goes up and I'm long Vega, I should make money. Now that can always be offset because of delta and theta. So all these things just trade interchangeably, and they're all related to the option I've got, because I now have to have 3 different Greeks in mind every time I make a trade. Because if I get the implied volatility right and the direction wrong, I might lose money. Probably will. Every once in a while, you can get the direction wrong and the implied volatility so right that you make money. So even if you're long a call and the market drops, there are times where the option will increase in value because of an implied volatility spike. When you go from 16% implied volatility, like where we're at right now for the VIX, and it goes to 80%, sometimes that just offsets that delta so much that it's okay. Not something I normally like to count on, but just something to have in mind, that sometimes selling a call against a stock position can actually hit you twice. Even when the stock goes down, you could have the call value go up, and vice versa. If you're long a call, even though it goes up, the stock goes up, doesn't mean the the option value will go up, because implied volatility can drop. And then there's the second order Greek that everybody likes to talk about, and that's gamma. So that's how much my delta is changing relative to a change in the underlying price. Because like I said, $100 stock, the $100 call is a 50 delta. Well, if you go from $100 to $102, well, the $100 call is now going to be higher than 50 delta, because the $102 call is going to be a 50 delta. So that changes constantly, and gamma is a great way to pick up leverage as the stock goes my way. I can pick up more delta, so my directional bias increases as I'm proven right by the market, and it decreases as I'm proven wrong. Because if the $90 call, or if the stock goes from $100 down to 90, the $100 call is not 50 delta anymore. It might be 10 delta. So I'm reducing my delta risk every time the stock moves against me. I'm increasing my delta exposure when it goes my way. And I actually like that for a trend following system, because trend followers tend to believe we should be increasing leverage as we're proven right and decreasing our position as we're proven wrong. Options naturally do that. That is one of the great things about them. So with that in mind, we will jump straight to the simple trick for improving your trading odds. There are 2 steps necessary. Before we even get to this, let me just tell you kind of the story that I was picking through as I decided to come up with this topic. I've got all these people that I talk to all the time, and one of the big things that I've heard from people is that, the stock went my way and I lost money anyway. What happened? When you start digging through, and it's that $100 stock buying the $110 call, and the stock goes from 100 to 108. So we never got through the strike. 110 was never a good price point. There's a reason we lost money. It's because the market didn't move as much as was needed to start making money. Or we have a $100 call where the stock only went up $2 and we needed $5 to break even, and we needed $10 to really appreciate the leverage. So the leverage wasn't playing out the way people wanted, and that's happening a lot in the market because realized volatility is so low. And like bar none, I think the most common story was that people are buying these out of the money options because they look really cheap, which I don't necessarily disagree with. They are, but there's no technical setup paired with it, or the technical setup isn't actually doing what they want. And on top of that, they're buying out of the money options that have short time to expiration. So they're very, very theta heavy. The market is then punishing them for lack of movement over the course of the week or 2 weeks that they hold the position. So to fix that, we start just talking about the adjustment to the trading strategy. Now, I want to increase my exposure to 2 Greek risks in the current market environment, given that, and I want to reduce my exposure to 1 Greek risk. The first one I'm really focusing on increasing here is the delta. And the reason I want to have more delta is because I want my position to be closer to in the money or already in the money when the market's not moving that much. Why? Because that on its own increases the odds of success. Delta is a proxy for the percentage odds that the stock will finish in the money. So if I buy a 30 delta call, I should only expect that call to finish in the money 30% of the time. And that's not even necessarily profitable, because we know we have to exceed the initial premium. So if I'm expecting that call to finish in the money 30% of the time and only make money 25% of the time, I can still have a very highly successful trading system, but my winners need to be multiples of my losers. And I can't sit there and say that I'm frustrated that I had 3 losers out of 4 trades, because that's exactly what I should have had. And I can't then turn that into saying I'm going to take small profits on my fourth trade just so I get a win. And people do that all the time. They say, okay, well, I'm trading all these options that do have this expected success ratio of 30 or 35%. But every time I get a winner going, I cut my profits too short and I let my losers run. That's a bad overall trading strategy. And it really hurts. Now, if psychologically that's what you want to do, there are ways to fix the trading strategy and increase your odds of success. If you increase the delta, you're increasing the odds of the trade finishing in the money and naturally increasing the odds of success. But there are new risks you are introducing when you increase the delta. Here's the general idea. We look at the normal distribution. Now, the normal distribution is telling us what we should expect over one day or 1 week or 1 month of movement for a stock. 68% of the time, the stock settles within one standard deviation of current prices, assuming a normal distribution. Now, a normal distribution isn't 100% accurate for the stock market, but for this big chunky area, it's close enough. When we get to the tails, it changes. So that's why some of those out of the money strategies can really work, because we see 3 standard deviation moves much more than 0.2% of the time. Now, if I'm betting on something happening where I want to buy a 30 delta option, I'm really kind of betting on a 2 standard deviation move. Now, if I have to bet on a 2 standard deviation move, that should really only happen about 5% of the time for both directions, and only 2 and change percent in the direction I'm betting on. That means every month it's going to happen, once, either up or down. So that requires really being good at predicting greater than 2% moves, because these 2% odds just don't give a lot of success ratios. Now, if I can bet on something moving upwards of 1 standard deviation, I can still make money with out of the money options. But when we stay in that 68% zone, roughly 2 out of every 3 days, 2 out of every 3 months, however you want to look at it, it's hard to make money with far out of the money options. So I want to increase my delta so that if we move from 0 to here, I can still make money, instead of needing a move above a standard deviation where, it's only going to happen 15% of the days in a month, so 3 or 4 times a month. I want to try to make money more frequently than that. So that's what we're betting on when we increase our delta, is we're increasing our probability of success so that the winners don't have to be as big in order to offset the losers. They can be 50% of the initial premium paid, 100% of the initial premium paid, or even 150% of the initial premium paid, instead of needing to be 3, 4, or 500% of the initial premium paid just to offset the losses. All right, so that's the key here, is making it more feasible to make that money, making it more likely to make that money, and also making it easier to stop out of a position, because when you're dealing with out of the money options, it's very hard to exit the position because they reduce in value so quickly when the direction is wrong. All right, just one moment here. I'm going to hand this back to Steve while I take a sip of water, and then we will get into the counter and the problems that can sometimes come up when we increase the delta of our position.
Fantastic, Keith. Thank you. It's been great so far, and welcome once again to everyone who has joined us to participate. Just a couple of quick reminders, and then I'll be handing it right back to Keith. Number one is if you do have any questions during the presentation or right at the end of the presentation, please put them in either the Q&A that you see on the bottom of your screen or the chat box. And both Keith and I will be looking out for those. Some of them Keith may answer during his presentation, and some of them will save toward the back. The other last quick thing is I'm not going to take the screen over right now, but I would like to promote the fact that our Option Hotline store is brand new as of approximately 2 weeks ago. We've got a lot of great products and memberships available in there. Some of the items are free. Some of them have a monthly charge. Some of them are a one-time charge. And a few of them even have a yearly charge. But The store is totally revamped, and we'd love to have you join us at optionhotline.com and check out the entire site, but especially the store. So thank you again. We've got a very nice sized group here. See a few questions coming in, so glad of that. And I think hopefully Keith is properly hydrated, and I will turn the audio back over to him.
All right, thank you, Steve, for that little break there. Before we go to the next question, there is a question already, and that's: do we recommend selling premiums on ETFs? Personally, I am not a big fan of selling option premium with the VIX at 16%, even though it's moving a little less than that. If I want to sell premium, I'm looking to take advantage of the term structure via something like a calendar that can collect theta but still be long implied volatility. That way, a spike in implied volatility, I can still profit. A spike in realized volatility, I can still profit. And if the market sits, I can still profit. There are ways to make money in almost any scenario with the calendar if I get it cheap enough. Selling premium has that increased risk of assignments, as we mentioned, but there's not a ton of premium to be collected simply by selling premium in the current market environment. There are spaces that there are premiums to collect. It's just not as easy right now as people may want it to be. Now, increasing the delta has a side effect. I increase my theta. What happens is, as I move closer to at the money with these options, let's say I'm looking at an option that expires in 3 weeks. My theta bill is going to increase. And why? Because I've now increased my premium. So instead of owning an option that may have been $100 of premium total, now I might be buying an option that's $400 per contract. Naturally, when I go closer to at the money, short term with short timed expiration, that can actually increase my theta. So we have to address that somehow. I've got to reduce my theta again, because right now the market's not paying me to own theta, to pay theta bills. So I want to reduce my theta and give myself more time for the trade to go in my favor, especially with the VIX as low it is. And the problem being realized volatility is even lower. So let's quickly take a look at the VIX. The VIX, as you see today, actually had cash trade down to 15%. It is the low of the last 6 months. It's really, over the last couple of years, that's about as low as we've seen it. I mean, especially since COVID began, we haven't seen implied volatility really this low at all. Why? Because there's always been some sort of uncertainty, some sort of potential for a fundamental input that could just crash this one-way train higher, which we've had some chop actually over the last 6 months, but overall the trend has been pretty favorable for the overall broad markets. At the same point, realized volatility, and there's an index called RVOL, that's the SIBO realized volatility index, is 9%. So as cheap as 15% seems, 9% means owning short-term options isn't working, because I'm not getting that much movement. I'm getting about 60% of the movement priced into the market. And it was even lower last week. We were down to 6%. So, if you're buying something for 18 or 19 that ends up being worth 6, that's painful. That's the problem with long options with short time horizons. That's the problem with just increasing my delta and saying that on a 3-week option, I'm going to switch it from being a 30 delta option to a 50 delta option. Because honestly, it seems a lot better to me right now to bet on a spike in realized volatility with those short-term options, and that's better suited for an out-of-the-money option. So if I don't want to bet on a spike in movement after all this consolidation we've been having, but instead I just want to improve my odds, then I got to get rid of some of that theta. When you look at theta, the rate of theta burn increases drastically in the last 30 days, and in particular in the last about week and a half. You can see basically the option value falls off a cliff if it's not in the money. So this is the idea that if my option is at the money, this premium falls off a cliff in those last 30 days. When I've got realized volatility this low, and I'm trying to improve my odds by buying an at the money option, I need to go and add more time. Maybe I need to be 60 days. Maybe I need to be 90 days. I need to slow that decay. And if I can slow that decay while also being long the VIX at a low level, so that if we do get a spike in realized volatility, I can still potentially profit because there may be a spike in implied volatility. That's good too. What I don't see a lot of is buying at the money options expiring in a couple weeks and then seeing the the realized volatility at 6%. We just don't offset the decay enough. So increasing the delta did me no good. Only if I'm betting on the big move do I offset the decay situation. So when I want to see that stock go to $120, yeah, okay, I can buy an out of the money call. But if I think the stock's going to go to 105, buying the $100 call for $5 simply doesn't cut it. I break even in best case scenario. So that's where people, I think, are really struggling right now in this market because we've switched to such a low realized volatility. Additionally, as I'm moving closer to at the money, you can see how that decay works. So this is fractions of a year, but you can see that as we reduce the amount of time to expiration, it's the at the money call that is decaying. Why? Well, because these out of the money calls just decay earlier. So they do most of their decaying and then they slow down the decay. Here, they do less decaying and then they accelerate their decay. Now you can see if I was doing the same $1,000 of premium, I would expect to pay more for an at the money call than these out of the money calls. So I could buy multiples of these. So I'd be buying 3 or 4, and that's where that theta then gets to a higher number for the out of the money option when time is further away. So when I have more time to expiration, I'm actually paying more theta because I'm buying more contracts. But then in that last 30 days, that at the money call decays so rapidly in the out of the money calls, if we haven't been moving, they probably already lost a lot of their money. And so they don't decay much anymore. They stay nickel or dime bid because it's too cheap to get rid of or whatever else. So, people just don't want to get rid of those options when they get too cheap or sell them outright if they get too cheap. That's that premium collection we were talking about before. So as a result of all of this, increasing my delta increases my theta. So I look to add time to my trade. So the net effect, I increase my delta to something closer to at the money or even go with a trade that is in the money. And then I add time to expiration in order to avoid increasing my theta bill. That's the simple trick, is literally saying instead of buying the July 16th $110 calls in this $100 stock, I want to buy the September $100 calls or the $95 calls, because now I've got the odds in my favor of the trade working. I've got extra Vega risk, which I'm okay with when implied volatility is this low. I've got less theta because I've got more time to expiration, which I like when realized volatility is this low, and I have time on my side. The options market basically gives you this massive menu. When you look at any individual name, you have hundreds of strikes in any of these, most of these higher dollar stocks. If you go down to like a $5 stock, okay, less than that, but you can have hundreds of option strikes to pick between. And it's hard to figure out which one's going to give the most leveraged return for the current market setup at times. So I think of myself ideally as like a wine sommelier. If you go to a steakhouse and they've got a 16-page wine list, it's really hard to figure out which wine sounds best with the steak you're picking. But if you can get a trade thesis that the market's going to continue higher on a trending basis, then we can start to say, okay, well, this is the wine, this is the option that you want to pair with your thesis. And right now, there are opportunities to go for those out of the money calls. But a lot of the leverage and a lot of the odds trading right now is built on longer time to expiration at or in the money because of how low the VIX is and because of how low realized volatility is. Those out of the money trades really need to be focused on individual sectors and individual names, not on everything. So the long-term options will help me ride out long-term trends. So I'm expecting to stay the course and continue the momentum. And if the market decides to change direction, I want to make sure that I have defined my risk using options to get leverage and define risk and adding a stop loss to further define my risk. That's the whole point here, is to add leverage, define risk, and increase the odds of success so that I'm not making money 30% of the time or given current realized volatility lower. I want to make money 60% of the time. And given realized volatility, I can still achieve that because if my option is more delta focused instead of gamma focused and theta focused and needing a big move, I can really do better. So how I use options for trending markets, I find a long entry that fits my triple moving average signal. If you want to learn more about that, you'll definitely want to check out some of the courses and things that we've got on the site on optionhotline.com. I'm also going to be sending my rules for how I roll my options positions in order to generate more cash as a free giveaway. But I structure my trade with 3 to 5 months to expiration, 65 to 80 delta options. So I was talking about 50 delta. I'm going in the money here. I'm looking for options that have a 70-ish% chance of finishing in the money, and ideally a 65 to 70% chance of being profitable. I have 3 to 5 months to expiration, so I don't have much data. I'm in that 90 to 150 day window that we see here. I'm at the back end of this, lowering that theta, increasing my vega risk with the VIX at lows, not trading for theta, not trading for gamma, it doesn't need a quick move. And if I get a quick move, I still make money. I just make a little less than I would have if I was trading a 3 or 4 week out option. So that's the structure that I use for option trend trader that I mentioned earlier, with last year's return close to 150%. Now, option trend trader is focused on the NASDAQ 100. That's a great sector to trade, especially what I'm seeing right now. We're starting to see some of these trends return in the NASDAQ. If you look at what we saw since really the beginning of the year, we've had 6 months of blase nothing move, right? We're up some, but it's not nearly as exciting as what we were seeing last year. And really all that move has come in the last month and a half. We were just going up and then down and then up and then down. And now we're going up again. And we made a new high again today. And you can start to see some of these moving averages, which I have in purple, green, blue, yellow, and red below here, lining up to tell me that this trend is starting to resume. Now, this may just be a repeat of April, where we hit a new high and then chop for a month. That's the worst thing I could see if I was betting on a breakout and betting on an option that expires in 2 or 3 weeks. But if I take an option that expires in 3 months, you could see that from April 19th to 3 months later, July 19th, this option still has a chance to work and might even be working today because we are higher than we were 2 months ago on April 19th. So if I start betting on things like this happening with an explosion over the next week, I can get burned. But if I start betting on something that can take 3 to 5 months to really play out, even if we have a drawdown and then a recovery, I can still succeed. Now, I think the NASDAQ 100 looks really interesting right now. I think this could start taking over some leadership from the other sectors because of market rotation, because people are starting to look for value again, because some of the other sectors have just run so much that you can go back to tech. The one flag I'm seeing is that semiconductors are not making new highs. Semiconductors have been the leader, the bellwether for the tech sector. So this again increases my desire to trade something at or in the money and increase my odds overall in the tech sector. Why? Because if semiconductors don't catch up, we may start to see a little drawdown in tech again. And I need to have time on my side and the ability to stop out of a position. If I trade for tech to move $6 in the next week, and we don't go up $6 in the next week, my option probably goes to zero quickly. If I'm betting on tech going up $6 in the next 3 months, I think I have decent odds of success. And if I see semiconductors catch up, I can be in really good shape here. So semiconductors is a key sector that I am really focused on to guide me on the next move in tech. The fact is, the triple moving average signal here is a little hairy still, but getting close to signaling a good long bias for semiconductors. And if that happens, this trend could really take off and gets me really excited for tech. Now, the more clear trend that's been happening overall, I think really since the election, is oil. Those of you watching oil have probably noticed it's up a lot. Gas prices are up a lot. All this stuff is happening because of what's going on in the Middle East and overall global macro relationships. Now, we made a new high in oil again today. Oil continues to be a great trending sector. So I can apply that same thesis to oil so that when we have whatever this was, 3-week period from the beginning of May to the end of May, so 3 to 4 weeks of no movement, I can still capture that move from 45 to 50 that occurred a month after I was first thinking about it. This is what we are working on with this increased time to expiration and decreased theta. Now, finally, along with oil, I can see some really good leverage for OIH right now. And I've talked about this a bunch in some like free blogs and things. So definitely check out our blog page at optionhotline.com. I do some weekly conversations. And one of my, this morning was actually about an oil company from Brazil, PBR, Petrobras. Now, the whole idea I'm thinking here with oil is that if oil prices are going to continue to trend higher, OIH should continue its trend higher. The problem is people get so scared of oil stocks going back down because of how badly they performed, I think, in the past. I think that's what's really driving a little bit of underperformance over the last few weeks. But it also creates an opportunity for a potential spike. But I can also apply that same trend following high probability philosophy to oil stocks, OIH, or individual names in order to increase my odds of success. So increasing odds of success doesn't mean I'm going to lose money when I'm right on the direction. What it means is that I'm making less money than I would have on an out of the money short-term call if OIH spikes to $280 in the next week. Woe is me, I made less money. I'm still happy because I'm going to have a lot of other trades that I'm making money on. Now, for me specifically, I took my Petrobras trade as a more leveraged trade with an out of the money call. But I've done a lot of other oil stocks with this high probability trade in order to help balance it out, because I know with PBR, personally, I'll probably make money 30 to 35% of the time on that trade, but looking to make multiples of the premium that I paid. Other names, I can offset that by making simply only, quote unquote, only 50 or 100% return over the course of a couple of months. So there's a lot of leverage out here. The two big sectors I'm looking at are tech and oil. Now, this actually leads me to talk about a product that Steve mentioned on the website before we even started here. How can I work for you? The key here to me is actually this max profits bundle, because I can add diversification by going into the S&P 100 stocks. I can't get into many oil names from the NASDAQ 100 because there just aren't many, if any. Not a lot of oil names are considered tech companies, but there are big ones in the S&P 100, ExxonMobil, ConocoPhillips, Schlumberger. These are names that I can leverage by adding in the S&P 100 stocks to my trend trading portfolio. So I can add more diversification. I don't have to be 100% tech focused. If tech continues to lag, I can still make money off of my S&P 100 portfolio where there are many more sectors that are leading. So this is why I wanted to bring this up today. I think this max profits bundle is a great potential opportunity for everybody. I definitely urge you guys to take a look at it. You still get the free stuff coming out after today. Take a look at the max profits bundle though, because that gives that opportunity to leverage all of these sectors as they're moving, not just tech, which was the great sector for 2020, but we know that in 2021, oil, financials, all these other sectors can start generating great leverage returns as well. With that in mind, we'll do some questions. I'll leave my contact information up so that if anybody has questions that come up after today, you can always email me or call me. And again, keep an eye out for that webinars at optionhotline.com email. We've got a free giveaway coming out tomorrow, and I don't want it to get in your spam folder, because if you don't get it for free, then you have to pay to get it, and that's not fun either. So I do see one question already, and that is a hypothesis. So if stock has a price of $100 and the $100 call is $1. Now, if one buys a call at strike price of 90 and that option price is $9, what happens to the price of the $9 call option at expiration if the stock goes to 110, if the stock goes to 100, and the stock goes to 90? So Sam, one quick note, if you ever see a call option pricing less than the stock price minus the strike price, buy as many as you can, and then immediately sell stock against it. So in theory, the $90 call, if the stock is trading $100, can never be worth less than $10. Option market makers, Citadels and people like that make a ton of money off of that. But let's just ignore that and just say that stock is that $90 call is trading for $10 and the $100 call is trading $1. On a move to 110, the $90 call will be worth $20. So it will double in value. On a move to 110, the $100 call will be worth $10. So it'll be up 9x return, so 900% return. There is a lot of required movement here for that to work out. Obviously, the market is basically saying that over the next week, the stock will move 2% or less. Because if the call is $1, the put's going to be $1. So that straddle is $2. If you're not familiar with straddles, feel free to email me more. But basically, the market is telling you that we expect the stock to trade within a range between 98 and 102. And if you stay in that range, the call only really makes money if you get to over $101. So it's a little bit more risky. But of course, that's where that leverage kicks in. That's why I was talking about in Petrobras. Like for me right now, I'm taking more of that kind of bet versus the farther in the money $90 call type position with longer time to expiration. If there are any other questions, feel free to throw those into chat or the Q&A now.
Keith, I do see one other question here. It's on the same topic that you mentioned as far as oil is concerned. Oh, hang on, I just lost it. 1 second. Oh, shoot. I'm sorry, I lost it. The question was about oil. And I'm sorry, I just vanished. But obviously, oil is going to be a very big mover and shaker for the upcoming year. Do you have any other things to say as far as oil is concerned?
Yeah, so I think that, just the way that oil tends to work under the Democratic presidency is that it does tend to go higher than I think what we saw. I mean, with President Trump, and there were a lot of driving forces that, he was proud of the fact that oil prices and gas prices were low. We've clearly seen a difference in the philosophy coming out of the new presidential regime, and there are reasons behind it. I'm not going to say one's better than the other. There are reasons behind it, and that should be a tailwind for many of these oil companies. That's why I'm excited about it as a sector, and why, as I mentioned, I'm excited about this max profits bundle for the next year, because I think that one of two things, and actually probably both, can work. But I mean, to get that exposure to oil type companies, that's where the S&P 100 kicks in more so than the NASDAQ 100. I think that there's a lot of room for the NASDAQ 100 to make up. But I mean, the return that the NASDAQ put down since the start of, well, really since a month after the COVID shutdown started, was incredible. And it's hard to say that that kind of return should be expected every year for obvious reasons. Oil companies lagged so much for so long that there's a lot of catch up to be played there, and a lot of portfolio rotation that can still occur. People that are heavily invested in tech are underperforming their peers who have invested more in the S&P 100 type names this year, and may need to continue to do that rotation just to play catch up. That can help drive oil prices higher, especially when oil company prices higher when oil is at highs anyway. So I think there's a lot of value here in continuing to make that oil type bet, but also I want to have diversification, and that's where NASDAQ 100 and the S&P 100 has many sectors in it, can really help out in case oil on its own isn't the performer that it has been for the last few months.
Got it. Thank you. And I did find the other question that I had lost for a second. You briefly touched on technology, but this question dives a little deeper. It says technology has lagged as a sector this year so far. Do you think it will become a leading sector again? And any guesses on the timeline for that?
Yeah, so I think that with tech, it can easily become the leading sector again. And the big signal for me is that semiconductor chart that I mentioned, because that had been really the key leading subsector of tech. So when I start seeing, I mean, and Sam, you mentioned here that yes, Skyworks, NVIDIA, Lam Research, they're at their tops. Not everything is doing nothing. AMD is not doing much here, obviously, and a few others are really lagging. But when we start to see the semiconductors as a whole perform better, it starts to give me more confidence that the whole tech sector, the broad tech sector, can continue to perform. When people are excited about the most I think important part of the tech sector, because semiconductors, they power all of our computers. I mean, we know that there are semiconductor shortages because of cars. Cars are having limited production issues because of missing semiconductors. Things like this just start to tell me, okay, well, when people start to see value in all the semiconductor companies again and really start pressing that sector ETF higher, then I'll feel more confident that tech on the whole can become a leader again. But right now, if semiconductors aren't leading, then I don't know that tech's leading.
Got it. Thank you for that answer. And we are just about out of time. I'm going to do a quick wrap up here, but before I let you go, Keith, anything else you'd like to mention before you drop off?
No, absolutely not. I appreciate everybody coming in. Hopefully you learned something interesting today. If you have any follow-up questions either on this strategy or any others, again, definitely email me. I always love talking option markets with people. So hope you all had an enjoyable webinar here, and definitely stick around for the for the website tour here that Steve's going to be giving.
Great. Thank you again, Keith, on behalf of all of our participants. We greatly appreciated this presentation. So for everyone that is with us, I'm just going to take a couple of minutes and run through the Option Hotline website once more. And when you do drop off, we ask you to please consider jumping on to the Option Hotline website right away and multiple times through the weeks. So very first, about Option Hotline. And this gives a little idea of who we are, what we are, and why we are. And we have a mission statement and our values statement. And below we have a little recap of all of our authors so far, and we will be actually adding 1 or 2 authors in the very near future. So thank you for taking a look at that. Just briefly also on our webinars tab, which we just finished up the webinar today. It's free education, as you know. We always have the current webinar, and we will always, after this comes down tomorrow, we'll have the next webinar featured on this calendar. And sometimes we have as many as 2 or 3 future webinars listed. Also, we do have replays of all of our webinars, and that will be up tomorrow as well, a full replay of today's webinar. And then we have replays for all of our webinars going back quite a bit of time. So you're more than welcome to jump in, watch and listen any of these archived webinars completely free. You can also share it with someone if you're interested in doing that. And last but not least, we have a brand new Option Hotline store, and we encourage everyone to give it a visit and poke around a little bit. I'm going to just open it up here for just a second. In the Option Hotline store, we basically have 2 categories, and still waiting for it to launch here. There we go. The 2 categories are products, and this would be referring to essentially a one-time product. Some of them are free, some of them have a price tag, but it's basically an electronic product that is a one-time purchase. You can see we have products from Keith, from Chuck Hughes, and numerous of our other authors. And then secondly, we have another category within the store called memberships. And as that implies, these would be ongoing memberships that you pay for, usually monthly, but some of them are for every 6 months. A few of them are for 1 year. But again, these are memberships in these products that you can come back as many times as you want, check them out as features, and they do have, again, monthly costs. Some of them, a few of them are 6 month costs, and some of them are yearly. But we would greatly encourage everyone to jump into the Option Hotline store, poke around a little bit more, and see if something interests you. And then, as both Keith and I mentioned, we have what's called the Max Profits Bundle, which combines Option Trend Trader, which you see on your left, and our S&P 100 product together. These make up the Max Profits Bundle. Normally, it is priced well higher than the price you see there. So it's a special deal, and you get an enormous amount of content and usable information for only $147 a month. So that wraps up the tour, and we once again thank everyone for joining us. Again, my name is Steve Fox. I'm the Chief Marketing Officer at Option Hotline. Keith is the Chief Options Strategist at Option Hotline. We will be having numerous more webinars throughout the summer. Please check the webinars calendar for upcoming webinars. And again, please visit our store. With that, we will wrap up. So thank you to everyone who has joined us and who has continued to stay on for the remainder of the presentation. And once again, feel free to reach out and contact Keith anytime that you wish, Keith at optionhotline.com. And once again, we greatly appreciate everyone joining us, and that will end today's webinar. Thank you.